Okay, thank you for submitting your homework. I guess this topic is the most difficult for you. Okay, so yeah, so if you have tried to answer the question, you can feel that more complication in how to calculate the cash flow and everything. Okay, so today we will move very slowly. So anytime you feel unsure about something or you want me to go back to discuss the concept, just let me know. So we can go back. We can always go back. Okay, so just make sure that you get the idea and the basic logic of this cash flow statement. Okay, okay, let's start. Let's start with some definition of cash flow statement. So cash flow statement is basically simply a summary of a company's cash inflows and outflows. Okay, so the statement will show the total inflows. Okay, so cash inflow and also cash outflows. Okay, and in the end, we will have the net balance of cash. So inflow minus outflow, we got the net cash flow. Okay, so this summary is only within a specific period of time. So typically we will prepare this statement only for one accounting period or one accounting year. So it's very specific for specific time period. Okay, so it basically tells the readers how much money is coming into the business or leaving the business. Okay, so this is the simple definition of cash flow statement. Okay, so let's start with the basic idea that the profit is equal with cash inflow. Okay, do you agree with this? Do you think profit is equal with cash inflows? Okay, so we have profit in the profit and loss, right? And cash inflow in the cash flow statement.
Sounds like profit.
Sorry?
Sounds like that's what profit would be.
So you think profit will be equal with the cash inflow?
As long as expenses are accounted for, it should be.
Okay. Any other comment of this basic concept? So in general, the profit will never be equal, right, with the cash inflow. Why? Because we have a concept called accrual. Okay, so we have accruals in the profit or loss, but we don't have this accrual in the cash inflow or outflows. What is accruals? Accruals is basically the non-cash transaction. So we have several transactions which is a non-cash in nature. Okay, so this kind of transaction will affect the profit or loss, but will not affect the cash balance. Okay, so the typical example of this kind of transaction is depreciation. Okay, so if we remember how we journalize the depreciation, we will have depreciation expense in the debit side, right? And then accumulated depreciation in the credit side. So you can see that there's no cash here. Okay, there's no cash involved in this journal entry. So this kind of transaction will not affect the cash, but it will affect the profit or loss in the income statement. Okay, so we have depreciation, We have allowances. So if the company set up an allowance for uncollected receivables, like a bad debt expense, it will also affect the profit and loss, but it will not affect the cash balance. Okay, so allowance for bad debt expense, allowance for purchase discount or purchase return. Okay, so any kind of allowance will affect the profit and loss, but will not affect the cash. We also have impairment, right? We have discussed impairment in the first tutorial, okay? And any other accrual transaction. Okay, so this kind of transaction will affect the profit, but will not affect the cash. That's why as long as the company apply the accrual principles consistently, the profit or loss will never equal with the cash inflows. Okay, so that's why the cash flow statement is really important for investors and shareholders, because sometimes they don't really believe with the profit and loss, because the managers could make up the profit or loss using this accrual transaction, but it's really difficult for manager to make up the cash flow statement, because cash is a real asset. Okay, so we can follow the flow of this cash in the bank account or in any other transactions. So typically investors have more confidence in the cash flow statement compared to the profit and loss. Okay, and investors also use the net cash flow as a confirmation of the company's profit. So if they show a company reporting a profit, so they have a positive profit in this profit and loss, and they also report a positive net cash flow, it means this profit may be valid from the investor perspective. But if they report a positive profit but a negative cash flow, so this profit is make up using these accruals. Okay, so the investor may have less confidence in this profit and loss statements. Okay, so cash flow statement is really important. Okay, to give a validation of the company's profit and loss statement, also to give a better picture of the real transaction done by the company. Okay, and it's give a different perspective of the company's performance. Okay, some simple terms in the cash flow statement. So cash inflow, basically money coming into the business. This money could come from the company's operation, like selling inventories or rendering a service. Okay, or coming from their investing or financing activities. Okay, like selling non-current asset or issuing shares. And then we have cash outflows, basically money going out from the business. If the company used the money or cash to pay some expenses or any other operations. Okay, and we have the net cash flow, which is simply cash inflow and minus cash outflow. Okay, so we'll have the positive net cash flow if the cash inflows is higher than cash outflows, and negative net cash flow if the cash inflows is smaller than cash outflow. Okay, so we should expect a positive cash flow from a good company. Okay, so if the company have a positive cash flow, it means they are able to generate cash from their operations. Okay, but if they have a negative cash flow, it means they are in trouble. Okay, they need an external financing to maintain their operation. Okay, so the question that you have to keep in mind while preparing the cash flow statement is what is happening to cash? Okay, so is it coming in or going out of the business? Okay, so if you saw a cash outflow, it means the cash is going out. Okay, so cash being paid to suppliers or employees or any other stakeholders. Okay, or if the non-current asset are purchased, the cash will be increased. Okay, and if they are sold, the cash will be increased. Okay, so just follow the money. Okay, when preparing this statement. Okay, so now we start with this basic equation. We have discussed this equation quite often. Okay, so asset is equal liabilities plus shareholders equity. Okay, so if I take the changes in asset, okay, will be equal with changes in liabilities, okay, plus changes in equities. Okay, just simply take the changes of each account. Okay, and then if we divide the asset into two groups, so we have changes in cash plus changes in non-cash asset, okay, like non-current asset. Okay, is equal with changes in liabilities plus changes in equities. Okay, and if we are interested with these changes in cash, so if we want to calculate the changes in cash, we can rearrange the formula. So we can move this non-cash asset to the right hand side of this equation. Okay, so changes in liabilities will be equal with plus changes in equities and minus changes in non-cash asset. Okay, so this last equation is basically the main logical relationship between cash and other accounts in the balance sheet. Okay, so from this equation, we can predict that if the liabilities is increasing, what happened with cash? The cash will also increasing, right? Because we have positive relationship. Why this might be happening? Because when the liabilities is increasing, the company is adding more liabilities. They're issuing more bonds, or they are applying more loan from the bank, okay, in the form of cash. Okay, so the cash will be increasing. Okay, and if the liabilities is decreasing, it means the company use their cash to repay some of the liabilities. So the cash should be decreasing as well. Okay, so this is a positive relationship between liabilities and cash. Okay, what about equities? So if we have an increasing balance of equities, it means the company issued more shares to the shareholders, okay, or they are offering more shares to the market. So we should expect that the cash will also increase because they will receive cash from the payment of these new shares. Okay, and if the equities is decreasing, it means the company used the cash to buy back their shares from the market, then the cash should be decreasing as well. So another positive relationship between equities and cash. Lastly, if we saw changes in the non-cash asset or non-current asset, okay, so if this is increasing, it means the company use the cash to purchase more non-cash asset. Okay, so the cash should be decreasing, and if the non-cash asset is decreasing, it means the company selling some of the non-cash asset for cash. So the cash should be increasing. Okay, so this is a negative relationship. Okay, so this is the main logical relationship between cash and other balance sheet accounts that will guide you throughout the cash flow statement preparation. Okay, so you don't have to memorize any formula actually. You just simply get this logic and you can like predict, or you can analyze if some account is changing, what will happen to the cash balance. Okay. Okay, so next let's move to the component of cash flow statement. So we have operating cash flow. Okay, so this operating cash flow will capture the cash inflow and outflows from the company's main business operation. Okay, so this main business operation typically will be captured by the current asset, okay, and current liabilities. Okay, we also call this as a working capital, the working capital. So current asset minus current liabilities is the working capital. So basically, the cash flow from operating will capture the working capital of the company's operation. Okay, so the main relationship between current asset and current liabilities with cash is similar with the one that we have discussed. So if we have current asset in increasing trend, then the cash should be decreasing. Why? Because the company used the cash or transform the cash into other current asset. Okay, so more current asset means less cash. Okay, and if the current asset is decreasing, it means the company is transforming their non-current asset into cash. Okay, like collecting receivables or selling some inventories. Okay, so the cash will increase. Okay, what about current liabilities? If current liabilities is increased, then the cash will also increase because the company get additional cash by having more current liabilities. And if the current liabilities is decreasing, then the cash should be decreasing as well because the company used the cash to repay some of the current liabilities. So it's basically negative relationship with the current asset and positive relationship with the current liabilities. Okay, so we will observe this kind of relationships in the operating cash flow, especially if we use the indirect method. Okay, next is investing cash flow. In the investing section, we will capture the company's activities in investing their cash in the non-current asset and PPE, property, plant, and equipment. Okay, so we simply observe the changes in PPE or non-current asset. So NCA or PPE. So if the PPE is increasing, it means the company used the cash to purchase more PPE or non-current asset.
What's PPE, sorry?
PPE is plant, property, and equipment. Okay, so if PPE is increased, then the cash will be decreased because the company used the cash to purchase more PPEs. Okay, and if non-current asset or PPE is decreasing, right, it means the company is selling some of their PPEs for cash. So the cash should be increased. Okay, so we will observe some negative relationship between PPEs or non-current asset with cash in the investing section. Okay, but you have to be careful with gain or loss when the company dispose some PPEs or non-current asset, they always have gain or loss, right? So we don't report this gain or loss in the investing section. Instead, we report this in the operating section. Okay, so the gain or loss will be reported under the operating cash flow section. Okay, lastly, we have financing cash flow. This section will capture the alternatives that the companies use to finance their assets or their operations. Okay, they can either use the long-term debt or debt financing or equity financing. Okay, so we'll observe a relationship between debt and equity and cash in the financing section. So if debt and equity is increasing, it means the company issue more bond or applying for more loan, or they're issuing more shares to the investors. So the cash will be increasing as well. And if this decreasing, the cash should be decreasing as well. Okay, because the company is repay some of the loan or buying back their shares. Okay, so another positive relationship between debt and equity with cash. Okay, and one more thing that we should be careful is the interest. If the company paying some interest out of their loan, we don't report this interest in the financing section. Instead, we report this interest in the operating section. Okay, because interest payable is part of the current liabilities. But if the company paying some cash dividend, we report this dividend under the financing cash flow. Okay, so interest in the operating cash flow, but dividend in the financing cash flow. Okay, so if we sum these three accounts, operating, investing, and financing cash flows, we will get this net changes in cash. So this one is basically 1 plus 2 plus 3. Okay, so and then if we add this net changes in cash with the beginning balance of cash, we will find the ending balance of cash. Okay, so this is the way we check our calculation or our cash flow statement. Okay, so if we add this net cash flow with the beginning cash, the total should be equal with the ending cash in the balance sheet. Okay, so if we don't have the same balance with the ending cash, it means we missed something in the calculation. So we have to check. Okay, so this is how we recheck the cash flow statement calculation.
So beginning should equal ending cash?
Yeah. No. The beginning plus the net cash flow. This is net cash flow. Should be equal with the ending cash balance. Okay, so beginning net cash flow equal with the ending. Any comment or questions up to this point? No? Okay, next.
Hold up. So
Yep.
change in cash should total 0 if you're adding all possible influences?
Why should be 0?
No, never mind.
Huh? Okay. So I don't think it's quite rare that we will get a 0 net cash flow. Okay, mostly we'll get a positive or negative. Okay, so if it's positive net cash flow, it means the cash is coming into the business, or if it's negative, it means the cash is moving out from the business. Okay, so it's very rare that we have a 0 cash flow. Okay, next we move to the operating section of the cash flow statement. In this section we have two methods. The first one is the direct method, and the next one is the indirect method. Okay, the accounting standard suggests the company to use the indirect method because in the indirect method we will have more detailed calculation instead of in the direct method. Okay, so if the company follows the accounting standard, then they have to use the indirect method for their financial reporting purpose. Okay, but sometimes they use the direct method to recheck their calculation using indirect method. Okay, so in reality they use both methods. Okay, so one method for financial reporting and the other one for just checking, okay, that they their calculation is correct, and then they have the accurate net cash flows. Okay, so let's start with the direct method. So in the direct method, we start with the total cash received from customers. So we have to calculate the total cash received from customers. Okay, the most logical way to calculate this cash collection is we use what we call as a account receivable cycle. Okay, so account receivable cycle basically explain that the ending account receivable is equal with the beginning account receivable plus sales, assuming that all sales are done in credit, and minus the cash payment, or sorry, cash collection. Okay, so minus the cash collection, we get the ending account receivable. Okay, now we are interested to calculate this part. Okay, so we can simply rearrange the formula. So cash collection is equal with the beginning account receivable minus the ending account receivable plus sales. Okay, this is basically the changes in account receivable. Okay, so beginning balance minus ending balance, and then plus sales. Okay, so this is the most logical way to calculate the cash collection from customers. So you can see that the formula, I think you don't have to memorize this, so just get the logic that the ending account receivable will be equal with the beginning balance plus any total sales if all sales are done in credit, and then minus the cash collection. Okay, and then just simply rearrange the formula. Okay, and then after we calculate this cash collection from customers, we deduct with the cash payment. Okay, so the first one we have cash payment for inventories. So for calculating this cash payment, we can use another cycle, which is account payable cycle. Okay, so this cycle explain that ending account payable, so ending account payable will be equal with the beginning account payable. So beginning account payable plus any purchase. So assuming that all purchases are done in credit. Okay, and then minus the cash payment to the suppliers. Okay, so if we rearrange this formula, cash payment for inventories, so cash payment for inventories is equal with the beginning account payable minus the ending account payable plus the purchase. Okay, so this is basically the changes in account payable. Okay, this is another logical way to calculate the cash payment for inventories. Okay, so again, you don't have to memorize the formula. Just get the logic, and then you can rearrange the formula. Okay, next is cash payment for interest. For cash payment for interest, we just simply add the interest expense. So we have interest expense in the income statement, plus or minus changes in interest payable in the balance sheet. Okay, so if the interest payable balance is increasing, it means the company receive more cash from this interest payable, so it should be minus. And if the interest payable balance is decreasing, so the company use their cash to repay some of the interest payable, then it should be positive. Okay, so it depends on whether it's increase or decrease. Okay, same logic for insurance and tax. So for insurance expense, we just simply add the insurance expense in the financial statement, income statement, plus or minus the changes of insurance payable in the balance sheet. Okay, and for tax, we add the tax expense in the profit and loss, plus or minus changes of tax payable in the balance sheet. Okay, so any other expenses will use the same logic. So if we have another payment for, let's say, wages or supplies, okay, so we just simply look at the expenses in the profit and loss, and then the changes in the balance of the corresponding liabilities account in the balance sheet. Okay, so if we add this, if we deduct this cash payment out of the cash received from customers, we will get the net cash flow from operation. So, okay, this is the net cash flow from operation. Okay, any comment or question using direct method? No? Okay, now let's move to the indirect method. So with the indirect method, we will start with the net profit or net loss, net profit or loss. So we should get this profit or loss from the income statement. Okay, so profit and loss statement. And then we add the accruals. Okay, so non-cash expenses or accruals. We add back this to the profit. So we'll have depreciation, and then allowance, impairment, and any other accruals. Okay, and then we add back the loss on sale of non-current asset. Okay, because we want to maintain cash only from operating activities, so we should add back any loss because of selling the PPE. And then we add the decrease in the current asset. So as we have discussed, if the current asset is decreasing, it means the company is transforming the non-current asset into cash. All right, so the cash should be increasing. So that's why we have positive. And if the current liabilities is increasing, it means the company receive more cash from the liabilities. So that's why we have positive. Okay, and then we deduct gains on because of this selling of PPEs, and then increase in current asset. Okay, so if the current asset is increasing, we assume that the company use the cash to purchase more current asset. So cash should be negative. And if the current liabilities is decreasing, the company is using their cash to repay some of current liabilities. So this one should be negative as well. Okay. And we also have the other section, which is the investing section. Okay, so we simply look at the balance or the changes of the non-current asset or PPE. Okay, so if we observe an increasing trend of NCA or PPEs, then we should minus this from the net cash flow from operation, because the company is using the asset to purchase more PPEs. And if we saw declining trend of non-current asset, then we should add this to the net cash flow from operation, because the company is selling some of the PPEs for cash. Okay, and then for financing, if we saw an increasing balance of debt or equity, okay, so if this is increasing, we should add this to the net cash flow from operation, because the company will receive more cash from this new issuance of debt and equity instrument. And if we saw a declining trend of these two accounts, then we should deduct this from the net cash flow from operation. Lastly, the dividend, cash dividend. If we have cash dividend, then we should deduct this from the net cash flow from operation. Okay, and lastly, we'll have the net cash flow. Okay, so from operation, investing and financing. Okay, this is pretty much the basic theory. Any comment or questions before we move to the homework? No? Let me turn on the light first. Okay, next is your homework. Okay, so the first one is exercise 6. So we have Emma, we have some information on Emma's balance sheet. We have the beginning balance of the account receivable and the ending balance, and also the sales. Okay, and now we have to calculate the cash collection. Okay, so we can simply use the account receivable cycle. So the ending account receivable will be equal with the beginning account receivable, right? And then plus sales minus cash collection. Okay, we can just plug the number to this formula. So the ending balance is 97. The beginning balance is 75,000. Sales is 1.1 million. Cash collection is the one that we are interested. Okay, so if we calculate this 2, okay, so let's add this, so 1.2 and then 97, then we will get 1 point something, right? So cash collection should be 1.18. Okay, so this is how we calculate the cash collection from customer. Any comment or question on exercise 6? No? Okay. Next, let's move to problem 19. So we have a Hildebrand company. We have some information on their balance sheet and also some information of their income statement. So the first thing that we have to learn is how we interpret these numbers, right? So if we have 2021 and 2020, it means this balance is at the end of the accounting year of 2021. Okay, so this one should be the ending balance, and this one should be the beginning balance. Okay, because the ending balance of 2020 is the beginning balance of 2021. Okay, then we can compare the trend of each account, so we can see whether it's decreasing or increasing. Okay, from the beginning balance up to the ending balance. Okay, so these three, oh sorry, this three is basically current asset. Okay, and this three is current liabilities. Okay, now let's start calculating the cash flow from operations. So we have to use the direct method. Okay, so we will start with the cash collection from customer. Okay, so we have discussed that the cash collection is equal with changes in account receivable, okay, plus sales. Okay, assuming that all sales are done in credit. Okay, so the beginning balance of account receivable is 1,500 minus 2,500 plus the sales is this one. 80,000. Okay, so we'll have 79,000 of cash collection from customers. Okay, are you okay with this? Any comment or question?
No, all good.
All good, yeah. Next is we have to calculate the cash payment. Cash payment. The first one, let's calculate the cash payment for inventories. So A for inventories. So we have learned that for inventories, we use the account payable cycle, which is changes in account payable plus purchase. Okay, so we have the account payable here, but we don't have the purchase. Okay, so we have to calculate the purchase first. The purchase will be inside of this cost of goods sold. Okay, so if you remember the formula of cost of goods sold, so cost of goods sold is the beginning inventory plus the purchase, okay, and minus the ending inventory. Okay, sometimes we add the transportation costs, but let's assume there's no transportation cost in this case. So it's just simply beginning inventory plus purchase minus ending inventory. Okay, so we can plug the number. So cost of goods sold is 55,000. Beginning inventory is 32,000. Purchase is, we don't know. We want to calculate this one. Ending inventory is 26,000. Oh, sorry, it should be minus. Okay, so 32,000 minus 26,000 is 6,000. So 55 minus 6,000, we will get this. 55 minus 6 is 49,000. Okay, so the purchase is 49,000. Okay, we can go back to this formula. Changes in account payable. So the beginning balance of account payable is 3,000. The ending balance is 4,000 plus 49,000. Okay, so cash payment for inventory is minus 1,000 plus 49, we got 48,000. Okay.
Sorry, so
Yep.
I also got the same result, but I did the different thing. I didn't really use the cost of goods sold formula.
How did you get the purchase?
Sorry, the cost of goods sold, which is 55,000, I just subtracted with the changes in inventory. And
Same.
So it's basically the same.
Yeah, so basically if this beginning minus the ending is the changes inventory.
Right, okay.
Yeah, so the beginning and this ending inventory is changes inventory plus purchase. Okay, I know in the textbook, they give you a lot of formulas to memorize, but I don't really like the approach. So I prefer to you to get the logic first, how this formula is derived. I mean, it should be a logical way of calculating the balance, right? So,
yeah, sometimes it's just that it's confusing to know whether it has a negative relationship or positive.
Yeah.
Like, for example, here is a decrease in inventory, but it's negative, but then increase in accounts payable is also negative. So.
Yeah, so if you know that the formula comes from this cost of goods sold, so you don't have to memorize actually. You just have to know how we used to calculate the cost of goods sold, and simply rearrange the formula to get the purchase or any other account within this calculation. Okay, any other comment? No? Okay, next is cash payment for this one. So general and administrative expense. Let's put it admin. Cash payment for admin is simply the admin expense. So the expense plus or minus changes in the liabilities related to this admin expenses. Okay, I think the supplies should be part of the admin expenses. So we should add or minus the changes in supplies. Okay, so the expenses is 6,000. Okay, these supplies is, if you look at the supplies, we start with 1,000 in the beginning, and in the end we have 2,000. So it's increasing. Okay, so we assume that the company use some of their cash to purchase more supplies. So this one should be plus. Okay, so plus 1,000. It should be 7,000. Okay, and next is cash payment for this one, interest. So cash payment for interest is the interest expense plus or minus the changes in the interest payable. Okay, in the balance sheet. So interest payable, we start with 2,500 and then we end up with 1,500. So it's decreasing. It means the company use some of the cash to repay the interest payable. So this one should be plus. Okay, so interest payable. Okay, so the expense is 4,000 and the interest payable is 2,500 minus 1,500, so 1,000. Okay, so we have 5,000 in total of cash payment for interest. Okay, lastly, we calculate cash payment for income tax. So tax is same formula. So we add the expense, tax expense, which is 4,000. So 4,000 plus or minus the changes in tax payable. So tax payable balance is decreasing. Okay, so we start with 2,500 and then we end up with 2,000. So it's decreasing. It means the company used some of their cash to repay this tax payable. So this one should be positive. Okay, so 4,000 plus 1,500. Okay, so we get 5,500. Okay, that's pretty much all. So 79,000 minus 48,000 minus 7,000 minus 5,000 minus 5,500. That will be the net cash flow from operation. Okay, we should get 13,500. Check, please check my calculation.
Sorry, I've got a question. So
Yep.
for the I use the total operating expense instead of just the general admin expense for the B side. So
This one?
yeah, I use for
it's difficult because in identifying any payment for cash, we should be specific as possible. Okay, so because if you use this one, you will incorporate the depreciation expense.
like a non-cash thing, is that why?
Yeah, it's a non-cash, so we don't have to incorporate this.
Okay.
Okay, so yeah, so if you got this, you may have an incorrect operating cash flow balance. Okay, so be as specific as possible. So just choose item, a specific item.
Like, sorry, is the way that you look at this, or then we look at every expense that is related to cash and then just use that?
Yeah.
Okay.
You look at the every expenses related to cash and then check the corresponding current liabilities in the balance sheet.
Yep.
Okay, and then add them up.
Thank you.
Okay, any other comment or question? No? Okay, the next one, we have to reconcile this. Okay, so next is reconciliation. In the reconciliation, we will use the indirect method. Okay, so we will start with the net profit. of this company, which is 9,000. Okay, and then we remove the accruals. Do we have accruals? Yes, we have this depreciation expense. So we remove depreciation, 2,000. Okay, and then we look at the changes in the balance of current asset and current liabilities. So these two, what happened with their balances? Okay, so if we look at current asset, we will have increasing balance of account receivable, and this one is decreasing balance of inventory. Okay, so as we have discussed, increasing balance of current asset means increasing cash, because decreasing balance means increasing cash because the company transform some of the current asset into cash. Okay, so we should add the one that is decreasing, which is the inventory. Okay, so inventory account is decreasing by 6,000. So add the inventory. So decrease in inventory by 6,000. Okay, and then we look at so this one should be plus, this one should be minus and minus. And then we look at the current liabilities. So if the account payable balance is increasing and the tax is decreasing, interest payable is decreasing. Okay, so if the current liabilities is increasing, means the company have more cash from this account payable, from this current liabilities. So we should add the increasing balance of account payable and deduct this decreasing balance of tax payable and interest payable. So okay, and the account payable increase is 1,000. Okay, so account payable increase is 1,000.
Sorry, sir. Just a question.
Yep.
If you go back to the last page, so for the indirect method that we're using, are we supposed to use everything that's like still non-cash, or still everything that's in the balance sheet that we have to rectify back?
No, if we use in that method, we use everything. First, we remove the effect of accruals, and then we identify what happened with the current asset and liabilities. Okay, because they are the working capitals that we should report in the operating section.
Oh, okay. So did you also use the accounts receivable before, or just the inventory and maintenance?
Yeah. We will minus this because this is increasing, so the cost should be decreasing, right? Because of this increase. Okay, so we have 3 items in the addition. Okay, and then now let's deduct some increase in the current asset. So we have increase in account receivable, which is 1,000. So we have account receivable increase for 1,000. Okay, and next is what is increase in the supplies. So supplies increase by 1,000. Also minus. Okay, and in the current liabilities, we have tax payable decrease by 1,500. So the company is using some of their cash to repay the tax payable. So minus 1,500. Lastly, we have interest payable decreased by 1,000. Okay, so interest payable decreased by 1,000. Okay, so hopefully we will get the same balance as the previous one. So previous one we get 13,500. Hopefully in this one we also get 13,500. Otherwise we make some mistake.
Oh, sorry, I've also got one more question. In the lecture slide that Nelson gave us, there's like loss on disposal of non-current asset. So if we have that, we'll also add it into the indirect method.
Yep. We add back the loss here. Yeah, loss. And then we remove the gain. If we have gain, we remove the gain from the net profit. Okay, so the idea is that this gain and loss is not from the main business operation of the company. So this gain and loss basically come from the disposal of non-current asset or PPEs. So we should get rid of the effect of these two accounts to the net profit. Okay, because we want to calculate the true cash flow from only from operating activities. Okay, any other comment or questions? Are you okay so far? No? Okay. Okay, next is the last one is problem 20. We have this company, intelligence company. So we have some information on their balance sheet and yeah, mostly balance sheet, and also some information on income statement. Now we have to prepare the cash flows using the direct method. Okay, and then prepare the reconciliation. So again, we will use the direct method. So we will start with the operating cash flow. So if we use the direct method, we need the account receivable, which is we have this in the balance sheet. And we also need the sales, right? It's because we have to use the account receivable cycle. So we need sales. Okay. Unfortunately, we don't have the sales information. So maybe something wrong with the equation. So the sales is missing. So we cannot calculate this operating section at the moment. So let's leave it for now, and then let's move to the investing section. Okay, for the investing section, we just simply look at the PPEs account, so property, plant, and equipment. You can see that there's an increasing balance of PPE around 185,000. Okay, from these two. Okay, so we assume that the company used their cash to purchase more PPE. Purchase of PPEs. So this should be a negative. 185,000. Okay. Next is, yeah, I think this is the only one in the investing activities. So now let's move to the financing. Okay, in the financing, we have to look at the liabilities account. So long-term liabilities. So we have this one, unsecured syndicated bank loan. Okay, so this one is the long-term liabilities. The balance is declining. So we assume that the company used some of their cash to repay some of this loan. So we can write loan repayment. Okay, should be negative because The company used the cash. Next, let's look at the equity account. So we have ordinary shares account. If we look at the balance is increasing. Okay, so we assume that the company is issuing more shares to the shareholders. Okay, so share issuance. Okay, 350 minus 70,000 should be positive because it is cash inflow. Lastly, let's check whether we have a dividend. Oh yeah, we have a dividend. So we have cash dividend of 25,000. So we have dividend for minus 25,000. Okay, so this is the net cash flow from financing activities. 70 minus 45. So we have 25,000 in the balance. Okay, now we can calculate the operating cash flows because we can calculate the net cash flows from the balance sheet. So if you look at this cash and cash equivalent account, okay, so basically we can take the changes of this account as the net cash flow. Okay, so you can see that the account is increasing by 20,000. Okay, so the net cash flow should be 20,000. The net cash flow should be 20,000. Okay, this would be the end result if we add operating, investing, and financing cash flow. Okay, so the net cash flow should be 20,000. Okay, because we don't have the sales information, now we can calculate the operating cash flow use backward from this net cash flow. So this one will be D minus B. Oh, sorry, D minus B minus C. So net cash flow minus investing cash flow minus financing cash flow. Okay, so 20,000 minus 185. So it's basically minus minus, so it becomes plus. And minus C is 25,000. Okay, so we will get our net operating cash flow. So 20,000 plus 185 is 205 minus 25, we will get 180,000. Okay, that's pretty much the cash flow statement. Any comment or question?
So is that that's not the sales yet, right? Or is that?
No, that's the net.
That's just the net from the operating. Okay.
We don't have the sales information, so yeah, we cannot calculate the operating cash flow from the beginning. So we have to move from the bottom and then moving to the operating cash flow. Okay, any other comment or questions?
It looks so simple.
Yeah.
But really.
Make it simple.
And then you try to do it and it's like,
Yeah.
I'm still like, I still sometimes confused. Like when I read the balance sheet, I don't know which falls into which category. And I just realized like, oh, okay, now it makes sense. But then, yeah.
I was so deeply lost, I couldn't get my homework done.
Yeah, it takes time and practice. So, but at least from this tutorial, you can get the logical relationship within this account.
Yeah.
Okay, so I think you can start from that.
Thanks for that.
Okay, any other comment or questions? Okay, and last part, we have to reconcile this cash flow statement. Now we use the indirect method in the reconciliation. Okay, so again, we will start with the net profit or loss. Okay, so net profit. The net profit of this company is, do we have net profit? Oh, this one, 50,000. Okay, so and then plus we remove the accruals. Do we have depreciation? Do we have? No, we don't have depreciation. Profit portion.
Oh,
Yeah.
what about the point 7? I mean, sorry, 6. The change in accumulated depreciation is a result.
Yes. This
Does
one
that
should
mean?
be. Yeah. We can calculate the depreciation from using these changes.
So it's 70,000.
Yeah. So so this is the depreciation basically. Okay, so we add this back to the profit. So depreciation is 70,000. Okay, so if you cannot find the depreciation in the income statement, just simply take the difference between beginning balance and the ending balance of the accumulated depreciation. Okay, so normally they will increase, the balance will be increasing, but if you have this decreasing balance, it means the company is selling some of the PPE. Okay, so you should calculate the original balance first before you deduct this difference. Okay, next let's look at the current asset. So the current asset, we have two current assets: account receivable and inventory. Account receivable is decreasing. Okay, so we should add this because the company is transforming some of the account receivable to cash, and inventory is also decreasing. So we should also add this because the company is transforming some inventories into cash. So 5,000 and 50,000. Okay, so first we have account receivable, okay, for 5,000, and inventory, okay, it's decrease for 50,000. Okay, so this is the current asset. Next, let's look at the current liabilities. We only have one current liabilities, which is the account payable. Okay, so if we look at the balance, the account payable balance is increasing by 5,000. Okay, it means the company is getting more account payable for cash. Okay, so we should add this one as well to the reconciliation. So account payable increase by 5,000. Yeah. Okay, that's pretty much all. So this is the net operating cash flow. Okay, so 70 plus 100, 170, and oh, okay, we got the same balance with the previous one, so this will be correct. Okay, any comment or questions?
Sorry, I just got some questions. So in the question there, like point number, I think point 3, 4, and 5, what does that mean in like the entire, when we're making the solution for it?
Which one?
There's like additional information the point number 3, 4, and 5?
Oh,
Where does that
okay,
help?
a portion of unsecured syndicated bank loan matured and was repaid during the year. So with out of this long-term loan, syndicated bank loan, there's some portion of this loan will be due within this year. So it will become a current portion of this long-term loan.
Become like a current liability. Is that what
Yeah,
it's
it
like
becomes current liabilities.
But we don't know how much of the
Yeah,
portion.
but yeah, we don't know.
So is that question just an additional information that we're supposed to ignore, or?
If we have the number, we should take into account, but we don't have the number. So we can assume that the difference, 2000, is the mature portion of the long-term loan, because the company have to repay this.
Okay.
Okay, because it's due. Okay, and then ordinary shares were issued for cash. I think it's very common that if the company issue the shares, they will expect additional cash from the shareholders. Okay, so we have discussed they will receive application fees, allotment fees, and call. Okay, and then property and equipment were purchased for cash. Yes, that could be okay. And then non-current assets were sold during the year. Okay. So do we have? For PPE is changing. Yeah, so it's increasing, right? So it's not a disposal, but this is addition of property, plant, and equipment. The change in accumulated depreciation is a result of okay. This is we should we don't really need this actually. We can predict that the changes in accumulated depreciation is because of the additional depreciation expense, but this information is to strengthen the prediction that we should take into account this depreciation.
So I also got one more question. So for the bank loan, if some of it matures this year, and if we assume that it's the difference, which is 20,000, shouldn't we add that also as a current liability in the when doing the indirect method, or?
Not really necessary, because if they want to do that, so the mature portion should be already in the current liabilities in the account payable. Okay, so they have to reclassify the mature portion in this account payable.
So okay, so it should be a different section of the balance sheet.
Yeah.
Okay.
So they should create another account, which is mature loan or loan in due. Okay, for this. But if they don't create another account, we assume that this mature portion is already included in the account payable.
Okay, so that's right. Okay, so that's why we don't use it in the indirect method. Okay, thank you.
Okay, any other comment?
I might jump in. Just two quick ones. Would you prefer to do the cash reconciliations before or after you've closed the expense accounts?
We have to close basically after the balance sheet and the income statement is finalized, then we can start doing the cash flow statement. Okay, because we will use the differences in all balance sheet and income statement account to predict the effects to the cash flows.
But could you do it without the expense accounts?
It's difficult because we have to know the cash payment. So what expenses is consuming the cash? Okay, so yeah, we should know that which expenses is consuming the cash, and then we can identify the corresponding liabilities in the balance sheet and also take that into account in the calculation.
Sweet. And the other quick one is reconciliation. Is that another word for just using the indirect method?
Yeah, simply like that. So,
okay.
So it's basically a way of checking your calculation. But in reality, we start with this indirect method first. So for financial reporting, the format will be like this. So if we follow the accounting standard, so the Australian accounting standard is the AASB, or if we follow the IFRS, we should use this format for financial reporting, and we use this format or the direct method format, this one, for reconciliation, for checking the consistency.
Thanks for that.
Okay. Okay, lastly, we have, yep.
I just have questions. Sorry?
Yep.
So yeah, I just have questions about the last problem. So like, if in the exam conditions, if I do the reconciliation first, I mean the indirect method first to find the operating activities, is there any problem? Because
No,
like,
I don't think it's a problem. So,
okay, so
yeah, you can start with the indirect method, because at least if you cannot understand both method, at least you must know the indirect method.
yeah, because like you just form the cash flow first, and then you find the operating activities cash flow, and you do the conciliations. But like in my case, I don't know how to find, because like in direct method did not give enough information to do, so I just do the reconciliation first. It's still fine.
Yeah, that will be fine. So instead of moving from the bottom, you can do the consideration and use this net operating cash flow as the as this operating cash flow in this A, in this part.
All right.
Okay, you can also do it.
Yep. Yes, sir. Thank you.
Okay. Okay. So let's discuss the last question, which is the discussion question. So the questions: the profitable companies always have sufficient cash. So always have sufficient cash. So the more profitable a company is, the less important it is to manage cash flows carefully. Do you agree with this? Any comment? No comment? Maybe this one. Yep. Go ahead.
Is that looking more at corruption and things?
Sorry, for what?
Is it more trying to keep an eye on cash flows going out? Oh, no. I've done everything before.
Okay, let me just bring you back to this simple concept. So we have discussed that profit is not equal with cash flow. Okay, so even a company is profitable doesn't always mean that they have sufficient cash in their balance sheet, right? So because the profit is basically the cash flow plus the accruals. Okay, so the first statement that profitable companies always have sufficient cash may be incorrect, because if the portion of accruals is dominating the cash flow in making up their profit, this company may have less cash. Okay, but still making profit. Okay, so this statement may be incorrect. So the point is that whenever the company making a profit, or even if they're making a loss, they still have to manage cash carefully. Okay, because the cash is the most important asset, the most liquid asset to finance the company's operation. So the profit is just like accounting profit or book profit, but the real activities or real business operation will be financed using the cash. Okay, so it's really crucial that the company, a profitable one or loss-making one, should manage the cash carefully. Okay, so how they manage the cash carefully? So mostly we have the internal control. So yeah, we have internal control system. I think you have learned this in accounting A. The internal control system for managing the cash. Okay, so we have bank reconciliation and segregation of duties and other ways of controlling the cash. Okay, but the point is that the company should manage cash carefully, regardless of their profitability. Okay, and one more criteria to evaluate the quality of financial report is typically the investor will see the time lag of accruals will transform into cash. So how long these accruals will transform into cash? So this is the time lag. If the time lag relatively short, it means the financial reporting, the company's financial report have a good quality. But if the time lag is relatively long, or even some accruals is failed to transform into cash, okay, then the financial report quality is somehow in question. Okay, so because accrual also reflect the risk of earning management. So the manager could use the accruals to make up the profit. Okay, by using a lot of accrual transaction, they could book a high profit, but they cannot change what happened in the cash flow statement. Okay, because the cash is more real and reflecting the actual business transaction. Okay, I think that's my comment on this question. Lastly, I want to remind you the second online quiz. The quiz will be available tomorrow morning, 9 a.m. and close on Wednesday, the next Wednesday, almost midnight. This quiz will cover two topics, the cash flow statement and shareholders equity accounting. Okay, so you will have 6 questions on cash flow statement and 6 questions on shareholders equity accounting. Okay, so the question will be multiple choices and you have 36 minutes and 1 attempt. Okay, and the quiz will be available on the UTS online under the assignment tab. Okay, so I will try to make the slide and video recording available as soon as possible, so you can have another review of the slide and video before you attempting the quiz. Okay, and hopefully you will get a good mark. Okay, so this is probably the most difficult quiz in this subject. Okay, so just do your best. Okay. Any comment or questions before we finish?
Yeah, I just have the last question, just to make clear. Like, there are 2 ways that we can calculate the operating activities cash flows, which is indirect and direct method. But for investing and financing activities, we just have only one way, right? Like,
yeah. So for financing and investing, we have only one method. So whether we use the direct method or indirect method in the operating section, we always have the same calculation for investing and financing.
so when the question tells us like form a cash flow statement using indirect method, it's just about the operating activities, right?
Yeah.
Not in the others. All right.
Yes, correct. Yeah.
This is my clear.
Okay. Any other comment or questions? No? Okay. So thank you very much. I'll see you next week then.
Actually, final comment. Fantastic picture on the final slide.
Thank you.
Yeah, that's a good throwaway.
Bye.